And I'm going to take the lead on the presentation tonight. I'm Judy Linder. I'm the Director of Development and Plan Giving at William Patterson University. And the slide that we're starting with doesn't quite actually look like campus today, but it's what I hoped for very soon. So I wanted to share a little bit of joy with you. Soon, these daffodils will be popping up all over campus. So I want to thank you all for participating. I want to thank our presenters, who I'll introduce in just a couple of minutes, but just wanted to kick off with a brief conversation about gift planning at William Patterson University. We have a subtitle, which is Gifting for Good. Joyful philanthropy provides our donors, our friends, with the opportunity to have the power for more control, more income, more joy, and less tax. The individuals who are on this page are 3 of our 55 members of our Hobart Society. Our Hobart Society allows William Patterson to celebrate our plan giving donors who have told us about their plans to include William Patterson in some way. And we have the great opportunity to celebrate their philanthropy throughout their lives. So the first person in the top of the slide is Professor Emerita Barbara Grant, class of 1954. Sadly, she passed away a little bit more than a year ago. And Barbara engaged with William Patterson with multiple charitable gift annuities. Russ and Saul, we'll talk a little bit about them in a few minutes. And she made a transformational and significant estate gift, which we will celebrate as a campus community sometime in the fall, hopefully post-COVID. On the left is my friend Mark Kazaki, class of 79 undergrad, master's 80. Mark informed us just about a year ago that he had established a trust and identified William Patterson University as a beneficiary. Richard Culp, class of 1958, is also deceased. Richard, during his lifetime, chose to name William Patterson as a beneficiary of not just one, not just two, but 3 life insurance policies, which will build an endowed scholarship in his name. So now you understand a little bit about gifting for good and why it's such a joyful opportunity. If you have any questions regarding planned giving at William Patterson, please visit us at wpunj.giftplans.org to find the gift opportunity that might be best for you. This is my contact information. My office phone is listed twice. You've got my email and twice. So there's no reason why you'll miss me. I want to thank you very much for giving me this opportunity. And now let's get into the reason why we're all really here tonight, to hear from 3 awesome professionals and experts in their field. So with us tonight, we have Russell J. Fishkind, partner at Saul Ewing Arnstein Lair. Saul is a member of William Patterson's Foundation Board of Directors. Maria Rollins, CPA. Maria is the managing partner at KRS CPAs. She's a 1991 William Patterson alumna. And she's a member of William Patterson's Plan Giving Council and the Cotsacos College of Business Advisory and Advancement Council. And we have Saul Simon, CFP, financial planner, wealth manager with Simon Financial Group. Saul is a 1984 William Patterson alumnus and he is a repeat WP webinar presenter. So without further ado, I am pleased to present to you Protecting Your Legacy Through Holistic Planning. Take it away, Russ.
Thank you very much and welcome everybody. It's a pleasure to be here with this panel. And I am going to jump in because we've got a lot of ground to cover and I want to give everybody an opportunity to ask questions as we go. So I'm just going to start by talking about this notion of holistic planning, like what is it and how do you do it? So I've spent the past 30 years as a partner at large law firms doing nothing but high net worth estate planning and probate litigation. And what I find is too often the planners are not integrating their skill sets. And therefore, what the clients get is fragmented planning, that their wills say one thing, but perhaps it's not integrated with the beneficiary designations of their life insurance, just by way of example. So what I'm suggesting is that for all the viewers, please feel free to ask questions. But what I'm hoping you get out of this is how you create a planning environment that's holistic, where your estate plan is integrated with your life insurance portfolio. And those two disciplines are working in concert with your accountant such that you're making tax efficient plans so that you can maximize your income tax deductions, you can maximize your estate tax deductions, and that tax planning dovetails with the investment management philosophy and portfolio so that we know that when it comes to, let's say, charitable planning, we know what the basis is on your stock portfolio, or we know what the basis is on a piece of property that maybe you'd want to give away, such that your plan collectively works together, hand in glove. Your estate plan, your life insurance portfolio, your tax planning, your investment management, and your charitable plan, all into one master plan. And that master plan should really be viewed on an annual basis. And why an annual basis? Well, certainly we've seen markets go up and down a lot over a 1 year period, but we also see tax laws changing a lot. And we're going to get into some of the tax laws that we think are coming our way. So a plan that might have worked 2 years ago might not work as well as you'd hope next year. So this idea of creating a master plan and reviewing it annually is really a big step towards creating a holistic plan. Jenna? And with respect to estate planning, what I like doing is starting off with a fact sheet. Now, pre-COVID, I used to send out a last will and testament fact sheet and then meet clients in my conference room. And we'd sit for an hour and talk about what the appropriate estate plan should be. The effect of COVID as to estate planning is that the New Jersey legislature has allowed estate planners to conduct their practices through technology. Uh, Prior to COVID, this was never the case. This is really a new thing. So therefore, it gives me an excuse when there are technology failures to say, well, this is all new to me. And Saul and others have seen that happen. So, but really what I'm trying to say is that we can now conduct a very thorough initial consult via Zoom or Teams or Skype, or hopefully when the pandemic passes the old fashioned way. And that after we look at the fact sheet, ultimately what you're going to want to have is a will or a what's called a pour over, POUR, pour over will and irrevocable trust. Now, which one is most appropriate, a will or a pour over will and irrevocable trust? It really depends on your situation. I know one of my friends who's on this call, Chris, right now is in California. In California, rarely do people just sign wills. They sign a pour over will, which pours the assets over into their irrevocable trust, so they bypass probate. If privacy is your issue and you don't want the paparazzi coming to the surrogate's court and taking your will and publishing it on the cover of the Daily News, then you use irrevocable trust because revocable trust bypass probate and you get privacy. So if what you're looking to do is reduce probate costs and gain privacy. A revocable trust is the way to go. I will say, for all the taxes that we pay in New Jersey, one thing that they got right is the probate system. It's cheap. It's usually under $100 and it's efficient. Usually doesn't take more than a week. So avoiding probate in New Jersey is not a big deal. Go across the Hudson to New York, it is. So also when we talk about wills, we want to talk about your fiduciaries, your executors, your trustees, and your guardians, because that can make all the difference in the world. Fiduciaries who are communicative and transparent with the beneficiaries, the estates usually are administered efficiently. Fiduciaries who are not diligent, who don't um, communicate effectively, or are slow to react, oftentimes that can cause a problem. So choose your fiduciaries carefully. And also with respect to your will, and we're going to get into tax planning shortly, you want to make sure that there's flexibility in the tax elections you can make. Footnote, we'll come back to it. Healthcare proxies. It always amazes me how many people don't have healthcare proxies. As long as you can make your own healthcare decisions, you don't need a healthcare proxy. But if you can't, if you're under anesthesia or otherwise unable to tell a doctor how you want to be treated, the appointment of an agent under a healthcare proxy is really critical, so they can step up and be your agent. And you can name multiple agents. So if you have 3 children, you can name your 3 children. If you want to name a spouse and one child, you can do that. They can work together as co-agents. Similarly, on a power of attorney, there's a durable power of attorney, which means you sign it today, it's effective today, and your agent can transact financial business for you. Or you can sign a springing power of attorney, like a jack in the box. It only springs up upon mental or physical incapacitation, and upon a recuperation, it retracts. You can name one agent or you can name multiple agents. Naming multiple agents actually has some attractive features in that there's a checks and balance, right? No one person can act without the consent of the other. So I'm finding many people like naming co-agents on their powers of attorney. Other inter other inter vivos trusts might include a third-party special needs trust, a irrevocable life insurance trust, a charitable remainder trust, a grant or retained annuity trust, a spousal lifetime access trust. These are just different types of trusts that, depending upon your goals, you might want to consider. So we start off with a fact sheet, then we look at your wills, your healthcare proxy, your power of attorney, and other inter vivos trusts. We pay a lot of attention to how you title your assets. Are they joint? Do they pass as joint tenants with rights of survivorship? Or do you have named beneficiary on your life insurance policies or your IRAs, your 401ks, and your deeds, so that the titling of your assets is integrated with the dispositive provisions in your wills? With respect to fiduciaries, I mentioned under your will, you have executors, trustees, and guardians. Under your healthcare proxy, you have agents, and under your power of attorney, you have agents. Under other inter vivos trusts, you have trustees. They're all under the category of fiduciaries responsible to manage assets for the benefit of others or make decisions for the benefit of others. As a estate planner, I have to tell you, in practicing law over 30 years, that the litigious nature of our society at times can just be jaw dropping. So many clients like to protect their asset base by wrapping it in, by way of example, a Delaware LLC or Nevada LLC for the West Coast, um, or a family limited partnership, because these vehicles, so long as the assets were transferred in, at the time the transferor wasn't just sued or having notice that they were being sued, but as long as you do it prophylactically, I've yet to see one of our family limited partnerships be penetrated by a plaintiff. So it's just a great way to protect your asset base. And as I indicated earlier, now as of April 2020, you can now sign your estate planning documents via Zoom or via Skype. So instead of having to drive to Princeton or Newark or come to our New York City office, we can do it through the comfort of our homes. Now, what's going to happen post COVID? Is Congress going to change these laws? We don't know. We're going to have to see. Jenna? So the reason that I keep referencing, we're going to come back to tax planning, is because right now there are a number of different proposals being formulated with respect to the estate and gift tax. And what's really interesting about the estate and gift tax is how it's affected by who we elect to be our representatives. And historically, not that one is right or wrong, but just so you know, historically, Democrats take the position that the estate tax is a bit like Robin Hood. We take from the uber wealthy, let's call it the top 1 or 2%, and we spread that revenue across the other 98% to keep their income taxes lower or to provide services. So the estate tax is a great generator of wealth. On the Republican side, Republicans argue, well, the estate tax is confiscatory. You know, it's a 40% tax. And this is after income tax and after capital gains tax. You shouldn't have a thing like death tax, and we oppose it. And not surprisingly, our elected officials on both sides of the aisle don't see this issue the same way. So what you get, Jenna, the next slide, please. What we're seeing, um, putting politics aside, is a bit of a yo-yo with respect to the state and gift tax laws. So if you're just to look quickly at this chart, you'll see how many times the estate and gift tax laws have changed just in the past 22 years or 23 years. Look at all the changes. So from 1997, 98, 99, 2000, this was a democratically controlled Congress who set the exemption at 600,000, meaning for an individual, if you had $1 million of assets and you died, the exemption was 600,000. 400,000 would be taxable at the 50% bracket. That's a big tax on modest wealth. Well, it went from 600 to 625 to 650 to 675. You could call that index for inflation, but it was a low exemption and a high rate of tax. When the Bush administration came in, they were of the opinion, hey, we don't like the estate tax, so let's exempt more people from it by increasing the exemption. So in 2002, you'll see this exemption at a million. 2005, it went up to a million five, then up to 2 million, then up to 3.5 million in 2009. And look at 2010, blank slate. Why? Because there was no estate tax. It's the year George Steinbrenner died, and his estate passed free of federal estate tax. But because they didn't have 60 votes when that bill passed, the exemption was due to roll all the way back to $1 million. In comes the Obama administration, and they decided, with then a Democratic controlled House and Senate, to fix the estate tax exemption at $5 million. You'll see it ticks up a little bit over the next couple of years because it was indexed for inflation. But what that meant was that for a married couple, that they could each protect $5 million from the federal state tax or $10 million cumulatively, that was pretty good. And anything over that, you'd pay, depending upon the year, about 40 to 45% in federal estate taxes. In comes the Trump administration, and you're going to see what happened. They doubled the estate and gift tax exemption under then a Republican led House and Senate. And the exemption went from 5.6 doubled to 11.2 and then indexed for inflation. As we sit here today, the exemption from estate tax is 11.7 million per individual. You can gift that money away to anybody and not pay gift tax. You can die and bequeath it to anybody and not pay estate tax, right? So that's a lot of wealth to pass free of federal state tax. In comes the Biden administration, and now you're going to look at what is being proposed in 2022, a rollback back to the future of either a $5 million exemption, which would take us back 9 years, or a $3.5 million exemption, which would take us back to where we were 11 years ago. And therefore, you need to be aware when you create your estate plan, A, do you have estate tax liability? And B, what tools are out there to reduce or eliminate the estate tax and to do it with flexibility? Generally, the answer is a lifetime, strike that, is a optional disclaimer trust, utilization of lifetime exemption trusts, charitable planning, and life insurance trusts. Jenna? Saul, do you want to just walk us through the utilization of life insurance and what you're seeing in the marketplace?
Yeah, sure. Good evening, everyone. Saul Simon, certified financial planner. First I'll start off by saying that life insurance is an asset class and it needs to be managed just like you manage your investment portfolio. And they come in different flavors, different sizes, different shapes, and they've become more modern that you're able to actually add, for example, a long-term benefit rider on a life insurance product. Um, the biggest point I think I want to bring to your attention is that we are living longer, which means that the cost of mortality has gone down in value, which means that the cost of insurance is less expensive to continue to insure yourself for, say, $1 million. So, so things that we should look at, because very often I just see people keeping their life. You bought life insurance when you were, in your 20s because you had kids, or you bought a home and you had a mortgage, or you had all these needs back then. And we're dragging these policies along and we're not really reviewing them and managing them. I'm independent. I could do an analysis, a review. But you want to stop and say, and look, what are my goals? What am I trying to do? And then you really want to get into the understanding of who should the owner be? What is the beneficiary arrangement, which is so tied in with this conversation of, financial retirement estate planning, because if you don't do financial modeling, if you don't put together your goals and your financial needs to confirm that you and your spouse have financial independence, people want to make gifts. They don't know if they can afford to make gifts. So we put together these models to show scenarios. And then when we understand the scenario and what it is we want to accomplish, now we come to Russell to say, okay, this is what we're needing, this is what we're doing, and can you help us fulfill the legal documents to have it be coordinated? All my clients have advisors. And what I find is their insurance man, woman, investment man, woman, attorney, there's no collaboration and there's coordination gaps. And what I do is I look at this 10,000 foot overview, looking and seeing, and 9 times out of 10, I'm seeing missed financial planning opportunities, and it's costing people hundreds of thousands of millions of dollars. So, take a look at your insurance portfolio, see if it's up to date, see if it's competitive, and see if it's fulfilling the goals that you have today, because I'm sure they've changed from yesterday.
Yep, I agree with that. And oftentimes, when I look at the insurance portfolio, my clients may have a taxable estate. So we assign the policy to an irrevocable life insurance trust. Or we look at their beneficiary designations and they may have a child who has special needs. So you don't want to name the child who has special needs as a beneficiary. They could lose their government benefits. So instead we name a third-party special needs trust. Or they may review the policy and say, tell you the truth, I just don't need it anymore. When I bought it, it was for a specific purpose, but I don't need it. And then we talk about, like Judy mentioned at the outset, gifting it to your favorite charity, of course, William Patterson. So life insurance is something that I think, Saul, you're right. It should be reviewed annually, and it should be part of your master plan, part of your estate plan, part of your investment management strategy, part of your life insurance strategy, tax planning, and philanthropic gifting. All should be reviewed annually. Jenna? Maria, could you walk through, this is really exciting stuff. It's hard for me to contain myself here because years of tax planning looks like it's about to change meaningfully, and you're all going to want to pay close attention. So Maria, take us through what you're seeing now and how you think it might come out.
Yeah, I agree with you, Russ. It is going to change meaningfully. There's a lot going on. We heard a lot of this talk during the campaigning right around election time. Now, we have 3 stimulus packages that have already, or the third one coming down too. So there has to be some change here, some revenue generation here, and this, what we have put together here is pretty much where the commentary is going. So as Russ mentioned earlier, the estate tax exemption is one area that we've heard a lot about. Currently, we have an $11,700,000 per individual exemption amount, meaning that you can give away $11,700,000 in your lifetime without paying any estate tax. It sounds like the numbers that are being thrown out there now are the 3.5 million exemption or 5 million exemption. Russ, in your chart earlier, we'd never seen that bar come down. It's always kind of gone up. So this would be the first time that the exemption actually has come down in the time that I've been practicing. So that's interesting in and of itself. But what we will see more estates subject to estate tax, and certainly in the areas that that we're all practicing in here too. But we'll have a lot more individuals paying and filing estate tax returns. Capital gain rates, we heard a lot of talk about capital gain rates. Currently, capital gain rates are taxed at a maximum of 20%, depending upon your adjusted gross income. We're hearing that capital gain rates for individuals or for income earners over $1 million could change from 20% to the highest income tax bracket, income tax rate of 39.6%. And that 39.6% is the highest rate that we had back in before 2017, before the Tax Cuts and Jobs Act. So we're talking about a 39.6% potentially tax on capital gains if your income is over that $1 million. On top of capital gains tax, we also have a 3.8% net investment income tax that many times capital gains are subject to that tax too. And capital gains could be from something happening in your investment portfolio. You selling a low basis asset. It could be from selling a home. You purchased your home many years ago and you're selling it, and there's capital gain in there. Or it could come from a business, from a pass-through business. Maybe you're a shareholder in a pass-through business entity. It could come from there too. So this is something that will impact, will be quite a big impact under this new administration. And then, as I mentioned, the income tax bracket. Currently, it's 37%, the top bracket, and the top bracket hits 37% at AGIs for married joint at $622,000. So under the Biden plan, the talk is that the top bracket will come in at $400,000 for married joint in that example at 39.6%. So we have an increase in the actual rate, and then a decrease in the threshold that rate will kick in. So that'll impact those income earners. But don't just think, income below 400 is not going to have a tax impact under the Biden plan, because it will. There are other changes that are coming in that'll affect individuals or married joint under 400,000. We're talking about limiting itemized deductions to perhaps 28%. So you'll have a benefit of only 28% of the tax deduction, not at your tax rate. So that's significant. There may be limitations on the deduction for retirement plan funding, and that they're looking at potentially a credit for that. So again, those higher income taxpayers may not have the initiative or the incentive to fund more into their retirement. So all of this tax planning, all of these tax changes really do require some tax planning strategies. And I like to say tax planning, income reduction, or deduction planning strategies in light of your estate plan and your gifting plan, because charitable giving, it comes into play quite a bit. To reduce revenue, you have an opportunity to reduce your income or increase your tax deduction. Russ, I don't think we mentioned the step up in basis in the talking about the estate exemption. So step up in basis currently, if an asset is left in an estate, the beneficiary is going to take that asset at today's current fair market value. That's a step up in basis. So the example I like to use is Dad bought a house 20 years ago for $150,000. He dies, it's in his estate, and now it's worth $1 million. And it passes over to his children today at the value of $1 million. The children tomorrow can turn around and sell that house. They'll have no capital gain and no tax as a result of that sale. If we lose that step up in basis, that property then would come to the beneficiaries at Dad's basis of 150. If they turned around and sold it tomorrow, they would have 850,000 of capital gain and have to pay the tax on that capital gain. So that step up in basis, coupled with the lower exemption, is really going to cause a lot of individuals falling into the estate tax regime, where we're not seeing that necessarily today. What's not on here is New Jersey. New Jersey doesn't have an estate tax currently, but New Jersey does have an inheritance tax, where if you're passing assets to beneficiaries that are not linear descendants, there is a tax. There is a tax in New Jersey for those types of beneficiaries. And then the last point on this slide is the state and local taxes. Currently, state and local tax deductions are capped at $10,000. So there's talk about repealing, that cap and allowing it. Now, states are already trying to get cute with, having different types of entity level tax, and New Jersey now has what they call a bait tax, where pass-through entities can pay the tax at the entity level, take the full deduction for federal purposes, and in effect, they're bypassing that capped $10,000 limit. But before we had this capped limit, we also had a much lower AMT, alternative minimum tax exemption. So, when we even, a lot of my clients in this area had very high state and local taxes, deductions on their individual returns, they were limited to those deductions because of alternative minimum tax anyway. So, and we're seeing states even becoming more aggressive, and they're not, the states are not in such great shape now either, and there'll be reasons for the states to look to increase revenue too. So I think that's what I have. So my feeling is, in my practice and what I'm seeing is, you want to have a plan in place that takes the the state tax rates and the state tax deductions and the long-term tax plan together with your estate planning and your investment planning and your charitable giving. Jenna?
Good. So you want to just go over investment management strategies and how we can integrate the investment management philosophy into the global master plan?
Yes, thank you. So investments. Investments consist of asset classes like your primary residence, various real estate investments. Insurance, I mentioned earlier, is an asset class. So there's a distinction of investments. I don't know who's on the line listening. So if we're working, we're in accumulation mode of saving money, of adding money to a IRA, 401k, 403b plan on a weekly, monthly basis, which is good to do, investing in various stocks and bonds. When you take and choose to retire a couple of years beforehand, you really need to now look at a distribution strategy as to how am I going to take the money out in a way that complies with the rules of the government, like something called a required minimum distribution. That money has to come out at age 72, which recently that number changed from 70 and a half to 72. And the tax implication, because all this money that you got deductions on now is going to be taxed. So investments go up and go down, and that's called volatility, and people see that as risk. There's a science to investing. So what I do is I put together something called an investment policy statement. It's an IPS, investment policy statement. It's about 12 questions, and the statement speaks what are my goals? What am I trying to do? Am I looking for income from this account? If so, when? What's the tax implications? So do you see the way I'm offering this education so that you actually get a sense as to putting in parameters so that when we choose an investment portfolio, it meets your needs? There's a science to this stuff. Again, what are your goals? Come November, December, I talk to accountants like Maria. We talk about tax harvesting to take advantage of losses and offset gains. And then lastly, there's something which is really important, which is called rebalancing. Rebalancing is the market's been on a tear. It's gone up greatly. I'm supposed to have 18% because there's a science to the allocation. And I'm now at 25 because the market, the Dow, the S&P has been really good. So what you do is you sell off about 7% of this asset called domestic, stocks, and you reinvest the money in these other asset classes. What we just did logically is we sold high and bought low, which is the ideal methodology and scenario of what people want to do when it comes to investing. So there's a lot more to talk about. Feel free to ask questions. It's my pleasure. Then now you go into the aspect of who should own this asset, how should the titling be, how do we create asset protection strategies with Russell and the legal documents.
Thank you. Good. Jenna? So I wanted to talk to everybody. We've spoken a lot about charitable planning, and I just wanted to address these concepts and answer any questions. When it comes to charitable planning, you can, of course, make a distribution outright, right? You can cut a check. You can transfer over stocks. But there are certain limitations that you want to be cautious of. That, for example, if you're giving something other than cash, it could be subject to a limitation on your adjusted gross income, for example, 30% of your adjusted gross income. So goes back to the point that even charitable giving should be done collectively with your team so that you maximize your income tax deduction and hopefully have perhaps a gift agreement with the charity, and therefore everybody's happy. Now, some people like to use donor advised funds as a way to put money away every year. Donor advised funds can be opened by Saul or many institutions. They're low administrative costs. They work very well. Perhaps not for the wealthy family who wants to be actively involved. If you're looking to be actively involved, you may want to think about a charitable foundation. Many of my clients create charitable foundations. They put money in during their lifetime and get the income tax deduction. They name board members, and every year they give money to their favorite charities, either outright or by a gift agreement. So between donor advised funds and charitable foundation, it really just depends on how proactive you're going to be, and are you okay with the administrative responsibilities involved with a charitable foundation, like filing 990s every year and filing a 1023 upon formation. So there's a fair amount of work that goes along with the charitable foundation, but many families really make that the cornerstone of their plan. So something to think about with your team. When you're creating a charitable plan, you might want to think about inter vivos during life or testamentary at death charitable remainder trusts. These are split interest trusts where, by way of example, I could provide my children get 5% of the fair market value every year is determined on December 31st. And at the end of the term, the trust terminates and goes to William Patterson. You don't get a dollar for dollar charitable deduction. You get a charitable deduction equal to the present value of your gift. So the longer the term, like if I gave my children a 20-year interest and William Patterson had to wait 20 years before they got the remainder, the value of the gift would be reduced because the present value of 20 years would probably reduce it by 60, 70%. Some people like creating charitable lead trusts, that the trust will be funded. You'll get the income tax deduction. It'll lead with the charity. So it's the reverse of a remainder trust. For a term of years, 5, 10, 15, 20 years, X percent, like 5% of the fair market value goes to William Patterson. And at the end of the term, the money then reverts to my children. So that's the difference between a charitable remainder trust and a charitable lead trust. Both can be initiated during your lifetime, in which case you get an income tax deduction. Both can be created through your estate planning documents, in which case you get an estate tax deduction. Now, I have some clients who say, that's a bit much for me. I'd like to just, upon my demise, give the asset to William Patterson now. Okay, that's called a bequest. And a bequest could be a fixed sum certain. I leave the sum of $25,000. I leave the sum of $250,000 outright to William Patterson. Or it can say, I leave this X sum to William Patterson, and then you can dedicate it to be used towards the music program or the nursing program or the School of Sales. So you can direct how the money is to be allocated. Now, anytime you talk about charitable planning, you always want to think about what is my goal? Is it to get, aside from helping the charity, am I looking to get an income tax deduction or an estate tax deduction? Or both. So I have many clients who will set up a charitable remainder trust during their lifetime and get the income tax deduction. And then at death, they'll create a charitable remainder trust and get the estate tax deduction. So this is why I say this kind of planning can't be done by any one professional. It's got to be done with a team, with the accountant, with the money manager, with the estate planner, and hopefully with someone on Judy's team, so that you can really integrate the gift with the university and you document that gift. And oftentimes I document it by utilizing a mission statement. It can be a one-page document, it can be a 5-page document or more, where you identify specifically what it is, what your goal is, and what you hope will happen with this foundation and who you're appointing as its members. And then you can also negotiate when you give a gift, things like naming rights, whether it's buildings or plaques. I know William Patterson doesn't like statues on their campus, but whatever you'd like to do, however you'd like your name to be commemorated, you want to negotiate that as part of your gifting. And then finally, I find IRAs, 401ks to be extremely ineffective wealth transference assets, because they're great for retirement planning, but in terms of passing to the next generation, we now have a shortened term that would be typically paid out in 10 years or less. That triggers income tax. They're also subject to estate tax. So if you were to combine the income tax with the estate tax, you're looking at a 75% tax and only 25% going to beneficiaries. So you can also gift life insurance policies, or if the step up in basis rules go away, you may want to consider gifting low basis assets. Anyway, this is just a thumbnail sketch as we come around to the bend and get ready to close up. I'm really highlighting the idea that things are always changing. Your life is changing, the laws are changing. Maybe your kids are marrying or they're having children, or you're selling your business. Life is dynamic, and our journey has so many twists and turns to it that the plan can't be static. It's got to be dynamic, interactive, with a team of professionals who care about you. And if you don't feel like you're getting that, then you want to plug and play and make sure you're bringing professionals in who work together as a team, who talk to each other, and collectively you create a plan that protects your family members and your favorite charities. Judy?
Actually, we're going to let Maria facilitate our Q&A. I think we've got a couple of questions in the chat box, and let's go there. Maria?
Okay. Okay, the first question was, I am interested in, these are the questions that came in of why you came in here. So does anybody have a specific question? I don't see any specific questions.
Well, there was one question about the Biden administration, and I would just note that generally speaking, when you have a Democratic Congress and a Democratic White House, what you're going to expect to see is the rate of tax go up on income tax and capital gains tax, and the exemption on the estate tax go down. And I think, Maria, you covered that well on the slide, but the timing as to the legislation, no one knows for sure, but the second half of the year is when we expect to see some tax legislation.
Yeah, I agree. I think we're working through this stimulus package now. And then once we turn the corner from there and we get into the summer with, the vaccine and COVID, advances on the coronavirus, I think we're going to see some movement there. I mean, we're already looking at tax plans. There was a lot of activity at the end of 2020. Everyone believing that the state exemption would come down at some point in time. Is it going to be retroactive? Is it going, when do we have to worry about planning for that? So we saw a lot of activity with planning, estate planning at the end of 2020. And I see it continuing. I don't really see that stopping. I know Russ and Saul, you're probably seeing the same that I'm seeing now too. And I'm seeing just tax planning, especially as we're working through tax season now with our clients. We're looking at 2021, we're looking at estimates, we're asking the types of questions that, what is income going to look like for you, and what can we do to reduce your tax burden? We talk. I know one of those slides, I think it was the last slide. I don't know, Jenna, if you can bring it back up. If that's easy and possible, is just that it talked about the different ways that you can gift, and they all do have a different impact, whether it's on your estate plan or on your current income tax plan. Yeah, this one right here, donor advised funds, bunching itemized deductions. A lot of individuals, they're not necessarily itemizing their deductions anymore. That state tax $10,000 ceiling, a lot of people aren't itemizing. So what do we do about getting the benefit of a charitable deduction? You can bunch your deductions into 1 year. We're seeing more of those types of donor advised funds. Charitable foundations came back in my practice a big way in 2020. We saw a lot more charitable foundations for clients and getting involved in that. And it's interesting at the level that you can get involved in that. Certainly donor advised funds you can get into at a lower level, but we're seeing more of that because we know this is coming. It's coming, and those that want control of their destiny are taking control of their destiny, and others are just kind of, riding by the seat of their pants. So my advice would be to take control and do what you can do.
I'll also just make a comment, and this is just a reminder. So we're all charitable to some extent, and instead of just automatically going and writing a check out of the checkbook for X number of dollars of cash, think about maybe using some stock.
Yeah.
There's a lot of appreciation in many, many stocks that we own. If and when you sell the stock to reduce your concentration in a certain stock and exposure into either an asset class or a specific stock, there's a capital gain tax. Well, when you give away, 5 or 10 shares of a stock, you're giving it directly to William Patterson University. They will take the shares because they have a relationship with an investment institution. They then sell it, and you get to reap the benefit of what the sale price is, and there's no taxation, and it's a charitable donation. So it's kind of being a little bit more efficient in making contributions using some of your appreciated stock, as a reminder. One more comment is, again, we're really just dotting I's and crossing T's. If in fact an individual wants to make a contribution, maybe upon their death, to various charities, the asset that would behoove you to use is a qualified IRA or 401k or 403b type of an account. And the rationale there is You could always split accounts. So if you want to put 100 G's and give it to WPU or cancer or what have you, you set up an account, you put 100,000 into it, and you name the beneficiary, the charitable organization, so that upon death, it's a full $100,000 receive of money, as opposed to your family or children getting the $100,000, and then your kids have to pay income tax on the 100,000 because it's an IRA, it's qualified money, it's never been taxed before. Any other questions? Want to open up the room to any other questions?
I don't.
All
see
right.
any
Well, I
other-
don't know what I'm having for dinner tonight, but
It's that time.
Yeah, I don't see any other questions in there, in the chat at all. I don't know if that's a good thing or a bad thing. Maybe we were so thorough that we answered all the questions as we went through that. But that's great. Okay, I guess Judy, you or Jenna could take that back.
Yes. Jenna, did you want to add any closing comments?
Sure, I'll just, thank you, Maria, Saul, and Russell, for sharing your expertise with us. And thank you to our alumni and friends who joined us here this evening. I hope you found this session, useful. And I encourage you to stay connected to William Patterson. And I'll turn it back to Judy.
Okay. So I think that just about wraps up the evening session. I also echo Jenna's thanks to our presenters and to our alumni who keep us connected, and we're very grateful for your engagement. If there are any questions following tonight's presentation, you will be receiving some communication from the alumni office with a survey to help us do this better in the future. And you can expect to hear a little bit more from the Plain Giving program and spreading the word. So I thank you very much. And I hope that for folks who are having dinner, have a good dinner and get your COVID shots so we can see each other in person. Yes, Saul.